Hello, students. This is Miss Michaud, and this is Accounting 1, Chapter 5, Lesson number 2. So to extend your knowledge a little bit, objectives, students will be able to 1. Explain the difference between permanent accounts and temporary accounts. 2. List and apply the rules of debit and credit for revenue, expense, and withdrawal accounts. 3. Use the 6-step method to analyze transactions affecting revenue, expense, and withdrawal accounts. 4. Test a series of transactions for equality of debits and credits. And number 5, define the accounting terms introduced in this chapter. So one good way to remember the rules of debits and credit is to use off, because you guys are awesome, right? AWE. So assets, withdrawals, and expenses. Their T accounts look like this over here on the right. So debit is always the left-hand side of a T account, and right-hand side is always the credit. But you increase assets, withdrawals, and expenses on the debit side, and the normal balance is always the increase side. And then you decrease these 3 accounts on the credit side. So remember AWE, assets, withdrawals, and expenses. Now other accounts, LOR, LOR. So liabilities, owner's equity, and revenue. So their T account looks like this. Again, the left-hand side is always a debit. The right-hand side is always the credit. But with these accounts, liabilities, owner's equity, and revenue, you increase on the credit side and you decrease on the debit side. And the increase side is always the normal balance. So this might help you remember this. In the last lesson, we talked about revenue and expenses and how that may affect your owner's capital accounts, and also the rules of debits and credits with these particular accounts. Some chapter vocabulary that we've already gone through, but it's worth mentioning again. Permanent accounts are those accounts that are continuous from one accounting period to the next. Balances are carried forward to the next period. So examples of permanent accounts include assets, liabilities, and the owner's capital account. Revenue recognition is the accounting principle that revenue is recorded on the day it is earned, even if you haven't received the cash. Okay. Now, temporary accounts are accounts used to collect information that will be transferred over to a permanent capital account at the end of the accounting period. So you want to keep track of revenue. How much money are you bringing in? Expenses, how much money is going out? Owner's withdrawal, how much money are the owners withdrawing from their business? So you want to keep track of this, and this is a really good way to do that. Remember, expenses is the cost of doing business, like rent or salaries. Revenue is money a business earns from the sale of goods or services. Withdrawal is when the owner takes assets out of the business for personal use. An accounting period is the period of time covered by an accounting report. And GAAP, or GAAP, is just referring to the generally accepted accounting principles, the way things should be done. Okay. So now we're going to analyze some transaction and put this information to use. Okay, let's assume on October 15, Roadrunner provided delivery service for Sims Company. A check for $1,200 was received in full payment. So you need to think about which accounts were affected, classify the accounts. Are they increased? Are they decreased? So therefore, are they debited or credited? And then create the T accounts for those. So if you write out a check for $1,200, that's cash in bank. you received the check. So that's cash and bank is going to be debited. And then you provided a service to somebody, so that's revenue. You delivered something. So that's delivery revenue for $1,200. So you're going to credit that. So the T accounts for that are going to look like this. You provided a service for somebody gave you money for that service. That increases your asset. So you want to debit cash and bank. And that also increases the amount of revenue that you've brought in through providing that service, so you credit. Okay, so usually when you debit one account, you credit the other. That's why at the end, all your debits equal all of your credits. Okay, this next transaction. On October 16, Roadrunner mailed check 103 for $700 to pay the month's rent. So now you're paying money out. So you'll be decreasing your cash and bank, therefore crediting it. And then paying for rent, that's a rent expense. So you're going to debit that. So the T accounts would look like this. You have less cash in bank, so you credit it. And then you've paid $700 of a rent expense, which is $700 more than you paid before, right? So that's the way to think about that. Let's continue analyzing transactions. On October 18, Beacon Advertising prepared an advertisement for Roadrunner. Roadrunner, your business, will pay Beacons $75 later. So you're going to pay somebody you owe money later. So that's accounts payable, right? So in this instance, you're going to increase how much you owe Beacon Advertising by $75, and then increase your advertising expense. How much does it cost to advertise in this business? So you're going to be debiting advertising expense and crediting accounts payable Beacon. So the T accounts would look like this. Debit your advertising expense. That's how you increase it. So you paid $75 more than before on this expense, and you credit how much that you owe Beacon Advertising. Okay, once you start to pay them, you'll debit that amount. Hopefully this makes sense. Let's continue. On October 20, Roadrunner billed City News $14.50 for delivery service. So we haven't received the money yet, but we will in the future. So that is considered an asset, right? Accounts receivable, City News is an asset. And delivery services, that's revenue that we provide. That's money that we're going to get for providing a service. So in this instance, we're going to debit the accounts receivable because we're going to increase that asset and credit delivery revenue. So let's take a look at the T accounts. All right, so we're going to debit or increase this asset, $14.50. And usually when you debit one, you credit the other, $14.50 for delivery. All right, let's continue. On October 28, Roadrunner paid a $125 telephone bill with check number 104. So you used a check, which is your cash and bank. You have less than you did before. So you're going to credit your cash and bank. And then a telephone bill is considered utilities. So you're going to debit utilities expense. Okay, remember when you credit one, you're going to debit the other and vice versa. So cash and bank is going to be credited $125 because you have less of that. And utilities expense is going to be debited. On October 29, Roadrunner wrote a check 105 for $600 to have the office repainted. Okay, so you wrote a check, which means we have less cash in bank. And then to have the office repainted would be considered maintenance expense. Always look at the business's chart of accounts. And so we're going to credit cash and bank, $600. and we're going to debit maintenance expense. I'm going to go back a couple slides. I think there may have been a mistake, so bear with me. Let's take a peek here. So yes, so on this one, we have less cash in bank. So on this transaction, this should be a negative. Okay. All right. So we'll load that back up and continue. Okay, the next transaction. On October 31, Maria Sanchez wrote check 106 to withdraw 500 cash for personal use. Okay, so you're taking money out of cash and bank. Therefore, you're going to credit the cash in bank, which means you're going to debit the other account that's affected, which is Maria Sanchez withdrawals. And the T accounts would look like this. Credit your cash in bank, debit withdrawals. What does testing for equality of debits and credits mean? It means to make sure the totals of your debit equals the totals of your credit. Okay, let's try problem 5.2 on page 116. Create a Google document and identify the assignment. Pause this video if you need to. All right, turn to page 115 in your textbook. All right, so what we need to do here is identify the two accounts affected and whether they're debited or credited, okay? So you issue check 543 to pay the electric bill for the month. So you're writing out a check. Okay, so cash and bank is decreased, so you credit cash and bank. An electric bill, okay, what kind of expense is that? That's utility expense, so that's an expense, it's increased or debited. So this is the way the T accounts would look there, right? So you're going to credit cash and bank, debit utilities expense. You want to keep track of the cost of doing business, so that's why you want to add your utility expenses together. Okay, let's look at number 2. You billed a customer for services provided on account. Remember, on account means it's a credit transaction. So that's accounts receivable, money you will get in the future as an asset, so that's increased. And then you provide a service. So you want to look at the chart of accounts, service fees as a revenue, and that's going to be increased or credited. So the T accounts would look like this: debit accounts receivable, credit service fees. Hopefully you're getting the hang of it. Let's try number 3. John Albers took cash from the business for personal use, which you can do, right? So we have less cash than before, so that's decreased. And you decrease an asset by crediting it. And John Albers' withdrawal is increased or debited. Oops. Let me correct that spelling error right now, right? So you want to debit it. Okay. So at this point, you're probably looking at your rules of debits and credit sheet. At some point, I'd like you to kind of get away from having to refer to that and try to remember these T accounts and which sides are debited and credited. All right, let's take a look at number 4. Issue check 544 to pay for an advertisement. So you have less cash than you did before, so you need to credit it. And what kind of expense is that? Advertising expense. So we paid more for advertising expense than we paid before this transaction occurred. So you credit one account, you debit the other. That's why debits and credits equal at the end. Okay, this is just another way to go through the problem. You could pause here to check your work if you want to. And now we're going to move on to problem 5.3. So please turn to page 122 in your book. So this is what the chart of accounts looks like. Remember that assets begin in the 100s, liabilities 200s, capital 300s, revenue 400s, and expenses in the 500s. It's always important to look at this and the different type of accounts. And here are our transactions that we need to analyze. Oh, they're not coming in on order. Here we go. All right. So Ron Hicks withdrew $500 from his business for his own use. So we have less cash in bank than we had before, so we credit that. And then Ron Hicks' withdrawal is going to be debited. Okay, let's try the next one. The business received $1,200 cash and rental fees. Okay, so you received money. So you're going to increase your cash in bank, and you're going to also increase the revenue by crediting it. Okay, because you have $1,200 more in cash in bank, that's an asset, and you received more money from this revenue. Okay, let's try transaction 3. The business paid a telephone bill of $85. So a telephone bill is utilities expense, and we're going to credit cash in bank because we have less cash in bank than we did before. Okay, so if we credit cash in bank, we need to debit utilities expense. And there was an analyzed part of this problem, problem 5.3. Oops, let's see. So calculate the amount of increase or decrease in the cash and bank account. So transaction 1, we started with 500, and then we subtracted $85 for transaction 3, and we increased $1,200 from transaction 2. So the cash in bank had increased by $615 in all. Okay, so hopefully this information helps. If you have any questions, please don't hesitate to reach out. Have a great day.